In this video, I'd like to talk about the major changes that are happening in the credit scoring system. So back in January of 2020, there's been a release in media talking about how credit scores are going to change over time and that millions of people will either see their credit scores rise or their credit scores decrease once the new credit scoring system takes place. So before I go and talk about what the major changes are, I'd like to first of all give you a brief overview in case you're not too familiar with how the credit scoring system works. So back in 2009, the credit scoring system called FICO 8 was released. And FICO is short for the Fair Isaac Corporation, which is the major credit scoring company that actually calculates credit scores by pulling in data from the three major credit bureaus, which are Experian, Equifax, and TransUnion. And basically it pulls the information or data that's already contained in the credit reports from the three bureaus and through its own algorithm calculate a credit score that many lenders use to make the decision of whether or not to extend you credit and what interest rate to charge you. So with the FICO 8 scoring model, it looks at five major factors. The first and the biggest factor is on-time payments, and that makes up about 35% of your credit score. So if you obviously make late payments, that's going to hurt your score. But if you make 100% on-time payments, then you'll maximize the 35% of your credit score, which could lead you to having a good credit score in that sense. The second factor in the FICO 8 scoring model is what's called credit utilization, or in other words, what percentage of your credit limit are you using of your credit card, and that makes up 30% of your FICO credit score. So obviously, if you are using your credit limit to its maximum limit, it's going to hurt your score. But anything considered credit use of under 30% of your credit limit is considered good. But if you can keep your credit utilization at 5% of your total credit limit, that can help you get to the excellent credit score with the FICO 8 model. The third factor in the credit score is the length of your credit history. So what happens is FICO looks at the average age of your total accounts, and obviously the longer you've had credit history, the higher your score will be, or if you're brand new to credit, you'll have a much lower score. So that factor is called average length of credit history, and that makes out about 15%. The fourth factor of the FICO 8 model is the applications for new credit. So every time you apply for new credit, the bank is going to pull information from either one or more of the credit bureaus, and it makes a note called a hard inquiry on your credit report, telling the credit bureaus that you did make an application for new credit. So the more that you're applying for new credit, and especially if you're applying for new credit within a short period of time, it's going to impact your credit score. And that makes up about 10% of your FICO score with the applications of new credit. And then the fifth factor, which also makes up 10% of your FICO score, is the mix of credit cards and loans. So if you have credit cards only and you make on-time payments, that's good. But if you have credit cards and a loan, such as a mortgage or a student loan or automobile loan, and you're making on-time payments, you'll get a much higher credit score because banks and lenders like to see a responsible use of both credit cards and loans and on-time payment history and low credit usage. So that makes up 10% of your FICO 8 score. So again, those are the factors that make up the FICO 8, which is what most lenders are currently using. So it's 35% for on-time payments, 30% is on your credit utilization, 15% is on your average length of your credit history, 10% is made up of applications for new credit, and then 10% is having that credit mix of credit cards and loans. So that's a current FICO 8 model, and basically with the FICO 8 credit scoring system, it takes a snapshot in real time of your current balances and your current use of your credit. So when FICO 10 comes around, it actually changes it, because with FICO 8, it's only looking at your current situation and your current credit use. But with the FICO 8, it's going to look at your previous 24 months experience of using credit. And this is the one area where most consumers will be impacted, because the FICO 10 considers how much debt you've had and how much of the credit that you've used over the past 24 months. So if you've been carrying, where this is going to hurt a lot of people is if you take out personal loans to actually consolidate your your debt, so that you can lower your interest rate, but you're still racking up more debt, then that's going to affect your credit score, because when the credit scoring model looks at you seeing your debt increasing over the 24-month period, it's going to hurt your credit score. But where consumers will see a rise in their credit score is if they see their debt usage going down over the previous 24 months, then that's going to definitely help your score a bit. So that's going to be the major change within the credit scoring system. It's not just going to look at your current month credit usage, but it's going to take into account your credit usage over the previous 24 months. Again, if the credit reports are showing that you are using and racking up more debt over the period of 24 months, then that's going to hurt your score. But if the credit reports actually show that you're decreasing your debt month to month, then that's going to help your score as well. So definitely that's an important thing to keep in mind when the new FICO 10 model gets rolled out. Right now nobody really knows when the new system is when the lenders are going to start using the FICO 10 system. But the important thing to keep in mind is, the credit basics, like keeping your credit utilization under 30% of your credit limit, or ideally under 10%. That's going to help your credit score. But also to not rack up more debt month to month. Obviously, paying your balances in full before the due date is going to help your score, because if you do carry balances month to month, and if the credit reports show that those balances are increasing month to month, that's going to hurt your score as well. So you want to focus on paying your statement balances in full before the due date. And another thing with the FICO 10 score is if you make a late payment, that's going to drop your score even a lot more compared to the current FICO 8 model. So again, those are the major changes that are happening within the credit system. Again, no one knows for sure when the FICO 10 model will be used by lenders. It could happen tomorrow, it could happen in 2 years, nobody knows, because again, many lenders have been using the FICO 8, which has been around since 2009. So that's just something to keep in mind. So just watch your spending habits, make sure you're making payments all on time, keeping your credit utilization low to under 30% of your credit limit, ideally under 10% of your credit limit if possible, and paying your statement balances in full before the due date every month. Then that can definitely help keep your score very high when the new credit score, when FICO 10 becomes adopted by many of the lenders down the future. So again, if you have any questions, just let me know. I'm more than happy to help and answer any questions you have about the new FICO 10 scoring system or any other questions you may have about credit. So again, thank you so much. I appreciate you watching this video.